Imagine you're driving at night on a long, winding road. It's dark, and the headlights only show you a few feet ahead. You don't know exactly what's around the next corner, but you trust your instincts as you navigate each turn. This feeling, a mix of uncertainty and control, is what risk management in investing feels like. It's not about eliminating risk entirely, because like those unknowns on the road, risk is always present, but it's about managing it, understanding it, and preparing for it. Risk is an inherent part of life. From the moment we get out of bed, we're making decisions that balance risk and reward. Do you catch a cold by going for a morning jog in the rain? Or do you skip it and potentially miss the early morning benefits of fresh air and exercise? These decisions mirror the ones we make in the financial world. Every investment decision involves weighing potential upside against possible downside. But how do we make these decisions wisely? It starts with understanding a few basics of risk management. Let's talk about diversification, something you've probably heard a million times. There's a reason for that. Imagine you're at a farmer's market with a basket. If you fill it with just one type of fruit and a sudden frost wipes out that crop, you're left with nothing. But if you diversify, filling your basket with various fruits, you reduce the risk of losing everything. In investing, diversification means spreading your investments across different asset classes, sectors, or geographies. It's about not putting all your eggs in one basket, and it can help cushion against the shocks of market volatility. But diversification is just the beginning. To truly master risk, you need to understand your own psychology. Money is deeply emotional. Fear and greed are powerful drivers that can lead us astray. When markets are soaring, greed can trick us into thinking we're invincible, prompting us to take on more risk than we should. Conversely, when markets plummet, fear can paralyze us, making us want to sell everything and run for cover. Managing risk involves being aware of these emotions, acknowledging them, but not letting them dictate your investment decisions. Think of your investment journey as sailing a ship. You need a sturdy vessel, your diversified portfolio, to withstand the storms. You need to be aware of the weather patterns, the market conditions, and economic indicators that could influence your journey. But most importantly, you need to know your destination, your financial goals, and risk tolerance. Different people have different thresholds for risk, just as some sailors prefer calm waters while others thrive in choppy seas. Understanding your personal risk tolerance can help you make choices that align with your comfort and financial aspirations. And then there's the concept of having a margin of safety, a buffer between what you expect from an investment and the worst-case scenario. It's like wearing a seatbelt in your car. You hope you'll never need it, but it's there to protect you in case of an unexpected event. When evaluating stocks, for example, it might mean buying shares at a price lower than their intrinsic value to provide a cushion against unforeseen developments. Ultimately, managing risk is about balance. It's about being proactive, not reactive. It's about setting realistic expectations and being prepared for both the good and the bad. Remember, every investment carries some degree of risk, but the goal isn't to avoid it. It's to understand it and navigate it wisely. As you think about risk moving forward, consider it an integral part of your financial journey. It's like that night drive. You're not in control of what's around the bend, but with the right tools and mindset, you can steer confidently through the darkness, knowing that each twist and turn is bringing you closer to your destination.